Imagine walking into like this dusty 19th century train yard.
Okay.
You have that heavy scent of coal in the air,
Yeah.
miles of steel tracks just baking in the sun, and just the sheer weight of all that industrial machinery everywhere you look.
Right. Very gritty.
Yeah, exactly. Now, sitting directly in the middle of all that grit, picture a glowing, multi-billion-dollar quantum computer server farm.
Wow. Yeah, those two worlds, I mean, they seem completely incompatible, right?
Totally incompatible. They represent entirely different eras of human industry.
It's a jarring image for sure. You have the ultimate symbol of like heavy physical capital expenditure just colliding with the absolute bleeding edge of the digital intangible age.
Right. Yet that clash of eras is actually the perfect lens for what we are unpacking today. So welcome to the deep dive.
Glad to be here.
And if you were joining us, you are here because you want to cut through all that daily financial noise. You don't need another avalanche of data.
Definitely not.
You want to understand the underlying mechanics of why monumental shifts actually happen in the market. So today, our mission centers on a highly revealing CNBC television interview transcript featuring Warren Buffett.
Yeah, this one is fascinating.
It really is. We are going to decode a staggering and honestly highly uncharacteristic move in the financial world. Berkshire Hathaway.
The ultimate old school guys.
Right, the ultimate anti-tech value investor. They have just poured over $31 billion into Alphabet.
It's massive.
Yeah. We are going to figure out the underlying logic of why this ultimate value investor is suddenly financing the AI revolution. We will get into the mechanics of that decision right after this quick note for our listeners looking to do their own sophisticated research.
Sounds good.
To access more advanced researches, applications, and our latest personal deep value agents, welcome to explore and join deepvalues.ai app. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice. Conduct your own due diligence before making investment financial decisions. Don't forget to like this video. Much appreciated.
All right, with that covered, we really need to establish the sheer scale and the timeline of this investment because, well, the numbers here redefine what a major portfolio shift looks like.
Yeah, they do. According to the transcript, Berkshire Hathaway started quietly building this position in the third quarter of 2025.
Which is pretty recent.
Right, but the acceleration recently has just been breathtaking. They executed a $10 billion private stock purchase, which, that pushed their total stake in Alphabet to north of $31 billion.
$31 billion. That's just...
It's huge. Now, let me play devil's advocate here for a second, because the immediate assumption across Wall Street was that this had to be the work of Greg Abel.
Oh, for sure.
He is the new CEO, the next generation of leadership. So the conventional wisdom was that Abel was finally dragging the Berkshire portfolio into the 21st century.
And, that narrative makes perfect sense from an outsider's perspective.
Right. It's the logical conclusion.
Exactly. You see a generational changing of the guard, followed immediately by an unprecedented allocation into a cutting-edge artificial intelligence hyperscaler. It looks like a clear pivot.
Yeah.
But the transcript throws cold water on that assumption almost immediately. Buffett explicitly states on the record, and this is a direct quote, "I initiated."
Wait, he actually went out of his way to clarify that?
Yeah, he did.
Wow. Because he noted in the interview that he normally refuses to answer questions about who pulled the trigger on specific trades.
Right. He usually keeps that internal.
But he felt the need to clear the air on this one.
He paints a very specific picture of their internal dynamic. Abel is undeniably the ultimate decider now. They consult with each other every single day, and they have veto power over each other's ideas.
Right.
But the genesis of this $31 billion leap into AI came directly from Warren Buffett himself.
Okay, let me stop you there, because from a conventional Wall Street perspective, this looks like a total contradiction of his own rules.
It really does.
Like, Buffett built his legacy by strictly adhering to his circle of competence. He understands railroads, he understands insurance flow.
Like Coca-Cola.
Exactly, consumer brands like Coca-Cola. If he personally initiated a $31 billion position in one of the most complex, rapidly evolving tech companies on Earth, how does that possibly square with his notoriously strict old-school value investing philosophy?
Well, it really forces us to reevaluate what his philosophy actually is,
Yeah.
Because Buffett doesn't evaluate a good business
Sure.
based on the product it manufactures or the service it provides.
Right.
He evaluates a business based strictly on capital efficiency and risk-adjusted returns. And in this transcript, He establishes a very concrete baseline for comparison,
Which is?
U.S. Treasuries. He points out that Berkshire is sitting on mountains of cash. I mean, they could easily deploy that capital into government bonds, which are essentially riskless,
Yeah, zero
and
risk.
quietly collect 20, 30, or $40 billion a year in yield.
So the hurdle rate for acquiring a company isn't just about beating the S&P 500. A target company has to significantly outperform the staggering amounts of money Berkshire could make by doing absolutely nothing.
Exactly. Doing nothing and taking zero risk. That is the crucial context. A phenomenal business, in Buffett's framework, must earn dramatically more than that riskless rate. But more importantly, it needs this structural capacity to continue earning that premium over a very long time horizon.
Okay, and he points to American Express to illustrate this mechanic, right?
Yes.
Because the American Express comparison was fascinating. It really breaks down the actual machinery of capital returns. He compares Amex directly to traditional commercial banks.
Let's look at the mechanics of that comparison because it's so revealing. A standard bank operates by taking in deposits and lending that money out.
Right, basic banking.
Basic banking. And by taking on that credit risk, they might earn a 13 or 14% return on their deployed capital.
Okay.
But American Express operates on an entirely different plane. According to Buffett, they're clearing a 30% or higher return on their capital.
Wow, 30%.
Yeah, and the magic of their business model is that they achieve that outsized return without taking on proportionally more risk than those standard 13% banks.
Because they aren't just a traditional lender, right? They've built this closed-loop network and a premium brand that acts as like a highly lucrative toll booth on global commerce.
You've hit the nail on the head. That is the holy grail of value investing for him.
Finding a toll booth.
Locating a business that generates exceptionally high returns on capital, minimizes downside risk, and sustains it for decades.
Oh, wait. AI is notorious right now for burning unprecedented amounts of cash on research and development without a clear, immediate path to, standalone profit.
Oh, definitely.
So how does Buffett reconcile the speculative nature of AI with the demand for hard returns? Because he brought up Charlie Munger in the interview, and Munger hated speculative trends.
Munger's influence is actually the anchor for this entire decision.
Really?
Yeah.
Right.
Buffett reflects on how Munger pounded the table for decades on one unforgiving concept. A business does not get a pass just because it is engaged in sexy things.
Right.
It doesn't matter if you are supposedly revolutionizing humanity with artificial intelligence or building colonies on Mars. If the enterprise isn't generating real, tangible cash, it is a speculative illusion.
Real cash. We aren't talking about creative accounting or, adjusted EBITDA or projected user acquisition metrics. We are talking about money you can actually put in the bank.
Exactly. Real cash.
Right.
Furthermore, it needs to earn that cash, be capable of distributing it to shareholders, or, and this is the absolute crux of the Alphabet investment, it must have the ability to organically re-employ that excess cash back into its own operations at those same high rates of return.
Okay.
A business throwing off cash is good. A business throwing off cash that also gives you an internal mechanism to reinvest and compound that cash.
Right.
That is an unstoppable wealth creation engine.
Which brings us to, I think, the most counterintuitive part of this entire deep dive.
Oh, the asset-light stuff.
Yeah. Because traditionally, the tech sector was defined by being asset-light. You had a handful of brilliant software engineers, some elegant code, and leased server space.
Right. Very low overhead.
You didn't need to build foundries or lay train tracks. And Wall Street became obsessed with that high-margin, low-overhead model.
Sure.
But the AI revolution has violently inverted that model. Alphabet and its peers are currently spending mind-boggling sums on physical infrastructure.
Unbelievable amounts.
So wait, if Wall Street usually loves asset-light operations, and now these tech giants are burning hundreds of billions on physical data centers, wouldn't a value investor run for the hills?
What's fascinating here is that paradox is exactly why this move is so brilliant.
How so?
Well, during the era when tech companies were purely playing the asset-light software game, Wall Street couldn't get enough of them. But Buffett stayed away.
Right, he famously avoided tech.
And in this very transcript, he explicitly admits, I made a mistake. He missed the first 2 decades of the tech boom because he fundamentally could not grasp a business model that didn't involve heavy, tangible capital deployment.
So he basically couldn't see the moat if it wasn't made of concrete.
That's exactly it. But now, the rules of the tech industry have shifted back to a language he speaks fluently.
Okay, I'm following.
These AI hyperscalers have morphed into what Buffett terms big cap spenders.
Yeah.
They are laying out hundreds of billions of dollars. And to put that into perspective, Buffett draws a direct parallel to Berkshire's fully owned Burlington Northern Railroad.
Ah, this is where that train yard analogy at the beginning comes into play.
Exactly. Think about the mechanics of the railroad business. Buffett points out that if his railroad were required to lay out $200 or $300 billion today, it would be a struggle.
Yeah, that's a massive capital call.
Because historically, that sheer volume of capital wasn't even required to build out the original railroad networks across the entire country. The sums of money that Alphabet is currently pouring into physical infrastructure, custom silicon cooling facilities, dedicated power grids, colossal data farms, it dwarfs the capital requirements of the Industrial Revolution.
So by pouring concrete and hoarding GPUs, Alphabet is essentially building a physical moat.
A massive one.
Once you spend $300 billion laying the track for the global AI economy, no startup in a garage can possibly afford to build a parallel track next to yours.
And that is the true aha moment of this interview. They are constructing an unassailable infrastructure monopoly.
Right.
Wall Street analysts are currently sweating during earnings calls because they despise seeing these massive capital expenditures keying into short-term margins.
They hate it. They always want immediate profit.
They are terrified of the spending. But Buffett looks at that spending and salivates.
Seriously?
Yeah, because the single hardest task for Berkshire Hathaway is finding a place to deploy enormous amounts of capital at a high internal rate of return.
Okay, that makes sense.
Alphabet has somehow figured out how to profitably deploy hundreds of billions of dollars. They are executing Charlie Munger's ultimate rule, reemploying vast amounts of capital at scale to compound their advantage.
It's as if Buffett is looking at Silicon Valley and saying, oh, you are no longer writing ethereal software. You are building a monopolistic utility grid for the future of human commerce, and you need endless capital to do it. Let me get my checkbook.
Exactly. He didn't understand the ethereal software game,
Yeah.
but he is a master of the infrastructure game.
That really highlights a massive disconnect between how institutional Wall Street operates and how Berkshire operates.
Very much.
Because during the interview, Buffett offered a rather biting critique of modern financial markets. He estimated that 90 to 95% of what happens on Wall Street is purely merchandising.
Yes.
Merchandising. Basically, analysts and brokers are just trying to sell financial products by obsessing over what the next quarter's earnings report will look like.
Wall Street is inherently short-term. They see a tech company spending $50 billion on data centers in a single quarter, and they panic because it compresses immediate profit margins.
Right.
But Buffett ignores the current quarter entirely. He is evaluating the internal rate of return a business can sustain over decades.
Which is a totally different time frame.
Absolutely. And to drive this point home, he relies on some powerful historical precedents in the transcript.
He uses John D. Rockefeller as a prime example of this long-term compounding mindset.
Right, he does. He labels Rockefeller as perhaps the most successful long-term investor in American history.
Wow.
If you look at the oil and gas wealth generated by Standard Oil, it has been compounding steadily for over 150 years.
That's incredible.
He also points to his own history with Geico.
Oh, right, the insurance side.
Yeah, in its early days, Geico was generating astronomical returns on capital. The math works beautifully when a company is small and agile. But Buffett candidly notes that maintaining those high returns becomes exponentially more difficult when a company achieves massive scale because suddenly the whole world is looking at you.
Right. Everyone is dissecting your margins and attempting to replicate your success.
Exactly.
Which describes Alphabet's current reality perfectly. The whole world, including some of the most well-funded corporations in human history, is looking directly at them.
100%.
Which begs a critical question. Here's where it gets really interesting. If this is an arms race to build the new railroad, why Alphabet?
Good question.
I mean, Amazon and Microsoft are throwing just as much money at the wall right now. They are all hyperscalers. Did Buffett explain why Google's parent company won his $31 billion allocation?
The interviewer actually pressed him quite hard on that specific point. Buffett navigated it with incredible tact. He refused to disparage Amazon or Microsoft.
Oh, interesting.
He acknowledges that they are all locked in this new capital-intensive game, and he makes a crucial observation. They don't have any choice. The competitive dynamics of the AI arms race dictate that if they stop spending, they die.
It is the ultimate adapt or perish scenario.
Exactly. And to illustrate the ruthless nature of corporate survival, he pivots to two very different but highly illustrative historical stories.
Okay.
First, he dissects the history of IBM from the 1930s through the 1960s.
IBM essentially owned the corporate technology market during that era.
They did. And Buffett notes that IBM would have been perfectly happy to freeze time.
Right. Just keep printing money.
Exactly. They would have loved to simply keep playing the highly profitable, comfortable game they dominated for 4 decades. But markets don't allow for comfort.
No, they don't.
A competitor eventually emerges, forcing the incumbent to drastically alter their business model just to retain their customers. Ultimately, businesses exist at the mercy of the consumer.
Wall Street might be easily fooled by merchandising, but customers are not.
Right. Now, the second historical parallel he draws is much more personal, and I think it perfectly captures the brutal reality of scale. He talks about his grandfather's grocery store.
Oh, yeah, he actually worked in his grandfather's store in Omaha,
He
right?
did, and he points out a sobering statistic. The family grocery business consisted of a single storefront in 1869, and 100 years later, in 1969, it was still just a single storefront.
Wow, so it was completely stagnant.
Totally stagnant. But while his grandfather's business stood still, another enterprise was playing an entirely different game. The Great Atlantic and Pacific Tea Company.
Better known as A&P.
Exactly.
You know, most people today don't even remember A&P, but they were the Amazon of their era.
They really were. In the 1930s, A&P pioneered a national-scale game. They revolutionized the supply chain, bypassing wholesalers to buy directly from producers.
Which allowed them to operate on razor-thin margins.
Right, while making up for it in an unprecedented volume. They were earning spectacular returns on capital and crushing local competition.
Okay.
But Buffett introduces a critical plot twist to the A&P story.
What happened?
Their national dominance made them the #1 target of federal trustbusters in Washington.
Oh, wow.
They held a seemingly unbeatable hand. But through regulatory intervention and changing market forces, that winning hand eventually vanished completely.
That is a chilling warning for any modern monopoly.
Absolutely.
You can build the most efficient, dominant capital engine in the world, play a game no competitor can match, and still see it dismantled by the government.
Yep.
But what really stands out in this segment of the transcript is that it shatters the myth that Warren Buffett is oblivious to technological disruption. You know, we view him as the Coca-Cola guy.
Right, the old school guy.
But he shared an anecdote from 1958 that proves he understands forced market transitions intimately.
You were referring to the data document story.
Yeah. He casually mentions that one of the most successful early investments of his career was a company formed in 1958 simply because a few of his associates read the newspaper.
Right.
They saw that IBM had settled a major antitrust lawsuit with the federal government. And as part of that settlement, IBM was legally forced to divest 50% of the manufacturing capacity of their absolute best business line tabulating cards.
Everyone in the industry knew it was IBM's primary cash cow.
Right. And Buffett, along with his partners, saw that regulatory mandate not as a crisis, but as an artificially created vacuum.
Yes.
They jumped in and built a highly lucrative business simply by absorbing the market share that the government forced IBM to abandon. I mean, this tells us that Buffett tracks the intersection of monopoly power, technological shifts, and regulatory intervention closer than almost anyone.
It completely reveals the true architecture of his investment thesis.
Yeah.
He is not analyzing Alphabet through the lens of abstract machine learning algorithms or futuristic tech wizardry.
No, not at all.
He is evaluating them as a dominant infrastructure monopoly that is currently deploying hundreds of billions of dollars to construct the indispensable railroads of the 21st century.
That's a great way to put it.
He is watching the historical patterns of IBM, of the A&P grocery empire, and of the early industrial railroads play out once again, this time in Silicon Valley.
So as we synthesize all of this, what does this actually mean for you, the listener?
Right.
The takeaway here is not a simple directive to blindly purchase tech stocks.
Definitely not.
The underlying lesson is a masterclass in how to evaluate a business over a timeline that matters. It requires aggressively ignoring the short-term noise tuning out the Wall Street merchandising machine that panics over next quarter's profit margins.
Ignore the merchandising.
Exactly. It requires avoiding the temptation of speculative, sexy trends that promise to change the world but fail to generate tangible cash.
Real cash.
And most importantly, it is about identifying those rare corporate engines capable of deploying colossal amounts of capital at a high internal rate of return over multiple decades. That structural advantage is the true engine of compounding wealth.
I think we should leave the listener with a final thought to mull over, drawing directly from the historical warnings Buffett embedded in this interview.
Oh, okay.
He went out of his way to highlight that A&P was an unstoppable commercial force until Washington trustbusters systematically dismantled their supply chain advantage.
Right.
And he specifically noted that IBM faced severe antitrust actions that forced them to surrender their most lucrative market share.
And those regulatory actions created the very opportunities that savvy investors capitalized on.
Precisely. So today, as Alphabet and its hyperscaler peers spend spend hundreds of billions of dollars constructing massive, unassailable new digital monopolies. We have to look down the road.
Okay, what do you mean?
Well, if they succeed in building the ultimate AI infrastructure, what happens to their supposedly unbeatable winning hand when the government trustbusters inevitably come knocking again?
Wow. That visual brings us full circle. You stand in that 19th century train yard and you watch them build a glowing, multi-billion-dollar server farm right on top of the old steel tracks.
Yeah.
It is undeniably the future of the global economy. It is an incredible compounding machine. But history tells us that building the most important monopolistic infrastructure in the world also paints a colossal target on your back.
Absolutely.
Thanks for joining us on this deep dive. We will catch you next time.